Credit Suisse stock is now at its all-time lows and is down by 60% this year. Its bond prices are at record lows, and the Swiss bank CDS, its credit default swaps, which is basically insurance in case the bank defaults on its debt, has been acting strangely recently. Credit Suisse's CDS prices are too high. Normally, the more problematic the condition is, the more expensive the insurance will cost. In Credit Suisse's case, the CDS is the insurance. The rule of thumb is if CDS prices are high, then the company is more likely to default on their debt. So when Credit Suisse's insurance got more expensive, this meant investor confidence in Credit Suisse's ability to survive with their current financial problems were low. This vote of no confidence has riled up the markets and is the one thing most investors point to show Credit Suisse is about to collapse. Then London's Financial Times and other news agencies reported that Credit Suisse executives have been calling large investors to calm them down, which is not a good look. The stock was down by over 50% this year. Their bond prices were low and their CDS prices skyrocketed. All this culminated in Credit Suisse's stock price dropping by 10% on Monday morning when trading resumed in the markets, bringing the stock price down by 60% this year. Lots of people on Twitter, Reddit, social media, and traditional media have been sounding the alert of the Credit Suisse collapse. We understand that investors believe Credit Suisse is about to collapse, but how is it losing money and why does the collapse matter? Well, the collapse matters because Credit Suisse is a banking behemoth. It's huge. The bank has over $1.5 trillion in assets and operates worldwide. That's a trillion with a capital T. In comparison, Lehman Brothers only had roughly $250 billion of assets under their management when they collapsed in the financial crisis. To make sense of this number, the assets Credit Suisse is managing is worth over 6 Lehman Brothers assets under management. So the Swiss bank's collapse would not be confined to its motherland Switzerland or Europe as a whole, but also the USA and the world at large. It would mean a worse financial crisis than the one we saw in 2008. With the markets already suffering, no one wants to see that. So why is Credit Suisse losing money? Throughout the years, Credit Suisse has had too many financial scandals. It was involved in the Bulgarian mafia's cocaine money laundering scandal. Then Credit Suisse was forced to pay $500 million after defrauding the family of an ex-Georgian prime minister. Credit Suisse also tricked investors out of $850 million to pay for a Mozambique tuna bond that ultimately went into the pockets of corrupt politicians. Then there was the Hail Mary, the Archegos scandal, where a certain Bill Huang made risky investments through leveraged investments from Credit Suisse, which failed and cost Credit Suisse $5.5 billion in losses. Credit Suisse also sold billions of dollars in Greensill Capital's debt to investors by telling them it was a low-risk investment, but the company collapsed. The litigation for this scandal will last 5 more years from now. Credit Suisse's reputation with scandals have soured its relations with investors who are reluctant to trust or invest in it. Credit Suisse has made over $4 billion in losses since 2021, and many of its senior staff and wealth managers, as well as executive deal makers, are leaving the company. The losses the company took were from the poor performance of their businesses, the money they had to pay because of the scandals, as well as investors they lost because of those scandals. Many analysts and retail traders are sounding the alarm over worries that the bank may collapse completely, triggering a Lehman-style crisis. Credit Suisse is aware of the negative sentiment on its stock and has been running damage control. They have been reassuring investors about the bank's survival. Meanwhile, there have been rumors that Credit Suisse's CEO, Ulrich Körner, had circulated a memo stating his intentions to raise money to solve the bank's problems. The problem is, a healthy bank should have no need to raise capital to save itself. The memo said that the bank was in a critical moment, which is why you see many headlines about Credit Suisse's doomsday scenario with the word critical in the title. Obviously, there's no actual photo of the memo, but it was seen by Bloomberg and Reuters and confirmed by a Credit Suisse spokesperson. Markets went wild with speculations of collapse and default. The CEO had to reassure employees and calm markets because of the negative sentiments. There were fears that the negative sentiment might encourage outflows, because why would a bank's wealthy clients want to keep their money in a bank that's rumored to collapse? The fact is, Credit Suisse is in a horrible situation right now. Honestly, if you have to explain that the bank is financially stable, then the problems are either already too large or you fucked up. Another worrying aspect of Credit Suisse is that its CEOs don't last long at the helm. Credit Suisse's CEO in the year 2020, Jane Tiam, was forced to quit because of a spy surveillance scandal, and his replacement, Thomas Gottstein, quit in mid-2022. And now the current CEO of the Swiss bank is Ulrich Körner. Ulrich's appointment to the position of CEO was interesting because Ulrich is a restructuring expert. He was brought in specifically to fix the company, enhance its wealth management business, and cut back or perhaps shut down some of the company's investment banking divisions. The Swiss bank has been in trouble for a while now, and it shows there are so many problems: the underperformance, money-losing segments in the company, the rising legal costs, and restructuring costs. It's not all doom and gloom though, because some investors see hope. Many analysts believe a Lehman-style crisis is impossible for Credit Suisse at the moment. Lehman collapsed because of their CDSs. They ran out of assets to put up against their margin calls, but Credit Suisse doesn't have the same problems based on the CEO's memo. The Swiss bank has enough capital and has strong liquidity, so fears of a Lehman-style collapse are overblown. Also, Credit Suisse isn't filing for bankruptcy. They are just looking to raise billions of dollars to save their company. Some are calling the panic and exaggerated reactions online scaremongering, while the CEO of Credit Suisse urged people not to confuse their stock's performance with their strong capital and liquidity. Even though Credit Suisse stock is trading at all-time lows and even below book value, many banking stocks are trading below book value right now since the pandemic situation in 2020. Citigroup, Ali Financial are all trading below book value, but their operations are doing fine, well, as fine as they can be in the current economic climate. Citigroup, one of the main banks involved in the financial crisis of 2008, said the Credit Suisse situation was night and day from 2007. A more reputable bank, JP Morgan Chase, chipped in and said that Credit Suisse's financial situation was healthy. Credit Suisse's CEO said the company was conducting a strategic review that outsider analysts believe could mean a few things. 1. The bank could sell some of its assets to raise money to fix its problems. 2. It could stop operating in some markets, like the US and Brazil, to save on operational costs. 3. It could shove all of its worst risky investments into a bad bank of their own creation. 4. Massive layoffs. Perhaps up to 5,000 jobs at Credit Suisse are at risk, or it could do all of those. Credit Suisse's 5-year credit default swaps are not as bad as the headlines will have you believe. A lot of CDSs are in bad shape because of the broader market sell-off this year. The investors need to be cautious in the current market. They won't favor banks like Credit Suisse with financial scandals. There is a 23% chance that the Swiss bank defaults on its bond payments in 5 years, which is saying a lot. If there's anything Credit Suisse has, it's time to fix its problems. Its liquidity concerns are completely overblown. The Swiss bank has strong capital it can deploy, and its liquidity is still strong according to the CEO and their balance sheet. At the very least, Credit Suisse's capital levels are higher than something like Citi in the financial crisis or Deutsche Bank in 2016. Credit Suisse's earnings reports from Q2 of this year showed its CET1 ratio was 13.5%, well above the regulatory minimum of 10.5%. This means the bank has excess capital. So why are there talks of raising capital? Why raise money if the bank already has money? Remember how the Swiss bank's current CEO Ulrich was brought in to restructure the company. Credit Suisse is raising money to fund the cost of a restructuring, changing the structure of a business and trimming excesses so it can become more profitable. Credit Suisse is a bloated company. It needs to be shrunk down. It can't continue losing money forever. However, the Swiss CEO can't shrink it without more money. Now, I know it sounds counterintuitive that a company needs more money to spend less money, but those money-losing segments aren't going to close themselves. A company restructuring of this size and scale isn't going to be cheap. Getting out of certain business segments will take many years and lots of cash to pull off. Credit Suisse needs a lot of cash to get back to their glory days. Credit Suisse needs a capital-light, stripped-down investment bank. You need money for restructuring. Exiting and perhaps selling non-core businesses costs more money. That is why people speculate that Credit Suisse may be forced to sell their assets. However, things aren't looking good for Credit Suisse. Even if they manage to sell those non-core businesses, they would get less money now. The current economy worldwide is faltering, so less profits from those businesses means new owners won't pay for what those Credit Suisse businesses are actually worth in a good economy. Some analysts expect Credit Suisse to ask for 4 billion Swiss francs to fund its strategic overhaul. It's not that the bank has run out of money. It's not going bankrupt. It just needs money to save itself. Credit Suisse still has the money it can deploy, but it doesn't have enough of it for the restructuring, which is why it needs the 4 billion francs, which is roughly $4 billion, for the CEO's restructuring efforts. The story isn't over yet. It's too early to jump into conclusions. We can only speculate if the bank will survive or collapse. Credit Suisse will announce their new strategic plan to dig them out of their situation on October 27th of this year. We will learn more about the bank and its financial situation when the time comes. I will be covering the Credit Suisse story as it develops, so subscribe if you want to be kept up to date about the situation. Thank you for watching.